Welcome to episode number 34 of the Zach Faust podcast. Today is a big day, almost a holiday if you're interested in rates and interested in the global economy. But before we get to our big holiday today, we want to bring up a big moment. I have these candles out in front of me. I want to continue to light them. I didn't light all of them yet. It's a big moment, not only for me as someone who's watched this group really just work their absolute tail off to grow to where they've been, but they've done so in the national headspace of many Americans. Not having a very great name amongst many Americans does not stop them. They push forward, they grow regardless. And as I light the 13th candle, let's go ahead and bring up on the screen what we're celebrating today. We are celebrating the $13 trillion mark being surpassed in assets under management for BlackRock. I even wore the hoodie, the BlackRock Social Club hoodie, just to celebrate. This is a big day. BlackRock assets hit record $13.5 trillion after market rally and a deal-making spree. So I'm just going to sing it out. Happy 13 BlackRock. I already blew out two, dang it. Happy 13 BlackRock. Happy 13 with all of your assets under management across the planet. Buying canals and power grids. Happy 13 and a half. That's a 14-digit number, by the way. To you. That was beautiful. Big W's in the chat, guys. I'm very excited by this in all the sarcastic ways possible. But with all that being said, today is a holiday of sorts for those that monitor the economy. We have the FOMC meeting with the Federal Reserve. And if you don't know what that means, that's great. Because what we're going to do is we're going to explain exactly what their job is, exactly what's on the table today, and exactly what it means for your finances moving forward. We have a nice little graphic that we're going to bring up now to start us off. This is the chair of the Federal Reserve, Jerome Powell. Jerome Powell's job is two. He is in charge of the Federal Reserve, and his two mandates are to keep jobs stable, keep the job market stable, as well as keeping prices stable. I actually use the other S word here. Keep jobs strong, keep prices stable. These are their two mandates over at the Federal Reserve, the two things that Jerome Powell is tasked with over at the Federal Reserve. That is their logo there. Now, we got a little video I want to play for us real quick to kind of get the scene set. We are walking into what is known as stagflation. Stagflation is not anything any economy wants to be a part of. And 11 months ago, he was asked point blank around what the game plan is around the potential of stagflation. And I'd like for you to listen to the question and hear his direct answer.
Hi, Chair Powell, Nancy Marshall.
Or the
Again, sir, with Marketplace. What is your plan if we start to see stagflation?
So that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out...
Just to be clear, this video is from 11 months ago. This is not recent. So when he talks about inflation coming down over a bit, he's not talking about right now. He's actually talking about last year. As of right now, since January, inflation has been ticking up. And if we go to our graphic, I want to explain to you first those two mandates, but I want to explain to you the scenario we're under. So here's how today is going to flow. I'm going to show you exactly where we're at with the two mandates, the job market and inflation. Once we have a firm foundation of where we actually are, I'm going to walk you through the decision that they're making today, because they're making a decision today at 2:30. We'll be live again, by the way, at 2:30, watching it together if you want to watch that. But this is going to be the decision they make. And it's going to be based off of rates. It's going to be based off of jobs and inflation. So we're going to walk through that. And then after that, I'm going to tell you what's going to happen from there. I'm going to tell you into the future what is going to happen after today's rate decision. So let's start with jobs. The job market is somewhat of an anomaly right now because many people have differing takes on what's going on with it. Let's bring up those tabs real quick. Or do we want to do this first? Do you want to do this first? Let's do this first. So let's walk through what their decisions are. So their job is to keep the job market strong. They do this by keeping keeping the job market at a healthy level via inflation. Now, if we scroll down real quick, they really have two different things they can do. Now, if they were to raise rates, what's going to happen to the job market? There's going to be less jobs. When they raise rates, they are increasing the cost of capital, cost of credit. And this limits lending. And when you limit lending, you are putting a stranglehold around job creation, wage creation. This is why many people call for us to cut rates. And that's our other option. If we were to lower rates, we would see more jobs. More jobs equals lower rate. That's really important. If we were to lower the rate continuously, we're going to increase credit more than likely and increase the strength of the job market. But if we were to keep rates the same or even raise them, we could see more pain in the job market. And that brings us to a few articles I want us to go over today, because the job market right now isn't doing fantastic. Let's start with jobs and then we'll move into inflation. This is from Reuters. U.S. job market is now a no fire, more fire job market. This is actually a quick little jab at Jerome Powell, because Jerome Powell and the Federal Reserve many times have stated that we're in a no hire, no fire job market. We didn't have a lot of jobs being created, but we also didn't see layoffs. That changed in the past couple of weeks. We can scroll down. We can see that Amazon, scroll up just a little bit. There you go, right there. Yep, we can zoom in. Second paragraph. Retail giant Amazon on Tuesday announced 14,000 layoffs, with more to come next year, while delivery service UPS revealed that it has a cut of a whopping 48,000 employees. The reasons cited include protecting margins, employing more artificial intelligence, we love that, and reversing pandemic era over hiring. Let's scroll down just a little bit real quick. These aren't the only eye-opening announcements recently. Around 25,000 workers are being let go at Intel, 15,000 let go at Microsoft, and 11,000 at Accenture. A lot of tech companies. Going down to that next one, it's in total that U.S. employees announced almost 950,000 job cuts since January. So we're going to see over 1 million job cuts this year. But don't worry, the job market's completely fine. There's nothing to worry about. Jobs are great. They're being created. No one's being fired. Stop being lazy. Let's go to the next tab to see more about the job market being great. There is currently a federal judge that is blocking Trump from firing more people. Let's scroll down and see how many people Trump was looking to fire. How many was he looking to fire? Isn't it the second paragraph? There it is. U.S. District Judge Susan Ilston, an appointee of former President Clinton. Holy cow, she's been in here for a minute. She was appointed by Clinton? Jesus Christ. Sided with the government employee unions when asked to bar the administration from carrying out the reductions in force. As the lawsuit moves forward, more than 4,000 workers were set to be impacted by the job actions. 4,000 more people losing their jobs. So we see right here, there are places from the government to private, the tech sector, that are all doing the same thing. They're cutting. They don't want AI to just be a part of their business. They want it to be you. They don't want AI to just be something that helps their employees. They want AI to be their employees. You don't, can I be real with you? You don't matter to these companies. The shareholder is what matters to these companies. The shareholder, an unbridled relationship with the growth of their own profit margins to entice the investment of like-minded investors is their only goal. So when the job market's struggling and we see AI is picking up the tab behind the way, I don't believe those jobs ever show back up. Let's go on to our last tab about jobs. This is an interesting graph brought to us by a friend of mine named Robert over at Infranomics. He went viral recently by making a version of this graph showing a very odd decoupling or K-shape from that dotted line. Can everyone in the chat, if you're watching this live, put 1 in the chat if you can see this graph and you can see that dotted line. That dotted line represents something very, very important. But first, let me show you what the black and blue lines are. The black line is the S&P 500. This is the status of our stock market, the strength of our stock market and our publicly traded companies. The blue line is job openings, amount of jobs available to the public sector workforce. What happened? We can see that both were growing and even dipped. Like if we look back at 2009, upwards of 2016, even that dip that happened during COVID, they move with each other. Job openings and the strength of the market typically move with one another, but all of a sudden, it broke. Now, we may be talking about correlation versus causation here, but I find it very interesting that November 30th, 2022 is the mark on this graph. Can we go to the next tab to show what else happened on November 30th, 2022? Oh, it's not there? Yeah, let's look up. What was released on November 30th, 2022? ChatGPT? What? No way! I swore it was something else. OpenAI releases ChatGPT as a free AI tooling companion. Let's go back to that graph real quick. That's the birthday of ChatGPT, that dotted line. So when we read reports of layoffs and companies like Microsoft and Intel and Accenture and UPS are saying, well, it says black screen. Why do we keep getting black screen on TikTok? Is TikTok good? In and out? That's interesting. Now we're back. Okay. We don't know what's going on, but we're here. So when we're talking about this graph here, and we also see layoff reports that are citing they want to use more AI, I think this graph only becomes more and more of a K, don't you? Don't you? Tell me this. Why wouldn't you, if you were the CEO of a company whose only job is to increase the value of the company, to increase the value for the shareholders, why wouldn't you get rid of that lazy 23-year-old with a degree? Who cares, right? Who needs that? Who needs to add some wages to the world of the working class economy? Why do we need good jobs? Let the robots do it. If the robots do it, the shareholders are worth more. The stock prices go up. It's obvious. They're gonna cut more jobs. And it's not funny. It's real. It's happening. And if you think AI is just a blip on the radar or AI is a fad, people thought the internet was going to be a fad. People thought tractors were going to be a fad. AI is here to stay, and it's already messing with the job market, which brings it back to our Canva graphic. Because the two mandates of the Federal Reserve are to keep jobs strong and keep prices stable. So if they were to keep jobs strong by lowering, or to keep the job market strong by lowering rates, creating more jobs, that could help. But if they were to raise rates, we would probably see less jobs. Now let's move over to the other mandate, inflation. Inflation has been the bane of our existence, and it revolves around their first mandate, which is to keep prices stable. Not to lower prices. Be very clear about the language they use. They never claim to be the ones that are going to help lower prices on anything. Their mandate is to keep prices stable. Now you may think, they've done a pretty terrible job at that. And you're right. They've done an absolutely atrocious job at that. But as we heard in Jerome Powell's talk in that last clip, the goal is to keep inflation below 2%. That is what's considered a healthy level. Keep inflation at a healthy level. Every economy, every fiat currency is going to have a moderate amount of inflation. Their job is to curtail it. So how do they do that? They have two ways of doing that. They can either raise or lower the federal funds rate. You may be thinking, is this their only tool? They have one other Mauska tool that we will tell you about later. That's for a special moment. But for right now, the main tool they have is rates. Now, if they were to raise rates, quick question for you. What do you think would happen to inflation? Nope. What do you think would happen to inflation if we raised rates? We already showed the answer. Inflation would more than likely come down. We'd have less inflation if we raised rates. Why? Because if we raise rates, we're limiting credit, we're limiting lending, we're limiting all of the ability for the economy to just ratchet off and go crazy. So if we raise rates, there's potentially less inflation. But what happens when we lower rates? More inflation. Now that's interesting, because didn't we just have a rate cut last month? That's very interesting, because aren't we in an inflationary economy right now? I'm confused. I'm really confused, because we are in a world right now where the inflation rate sits at 3%, meaning every single good or service that's core to your lifestyle as an American is 3% more expensive than it was last year. And that's coming off of a year where inflation was up 3.1%. And that's coming off of a year where it was up 2.9%. And that's coming off of a year where it was up 7%. And that's coming off a year where it was up over 9%. So tell me why we're lowering rates in an inflationary environment. The reason is we need to refinance our debt as a country, and we want job markets to be stable. So let's look at where we're at with inflation right now. We have a few tabs to show you. The first one is from CNBC. Inflation rate hits 3.0% in September, lower than expected. Long-awaited CPI report shows. If we scroll down, we have some sub-headline points. The Consumer Price Index showed a 0.3% increase month over month, putting the annual inflation rate at 3%, both lower than expected. Excluding food and energy, core CPI showed a 0.2% monthly gain and an annual rate of 3%, less than forecasted. Now, I want to just stop there. I had an experience on Twitter the other day with a gentleman by the name of Byron. I won't say his last name, but my good friend Byron. And Byron was under the understanding that a report coming in. Now, Byron's a very smart, economically focused guy. He's in the real estate world too. Our inflation coming in, let me just break this down real quick. Our inflation coming in at 3%. Does that sound good or bad? Just real quick in your head. Does that sound good or does that sound bad? Now, if we were to look at the articles and the headlines, even in that one, we'll see multiple times it says lower than expected, lower than forecasted. You're not supposed to be excited about that. I had my friend Byron on Twitter talking about how anybody talking about inflation is overreacting. It came in under expectations, guys. The Economist thought it'd be 3.1 and it's 3% now. That's great. That's good. No, the heck it's not, Byron. We're being told, oh, well, inflation's supposed to be a lot worse, but it wasn't as bad. So it's good. It wasn't as bad. So it's good. It was only as bad. So it's good. Inflation go up, prices go up, but that's good. No, it's not. It's not. And you're being told, you're being a form of propaganda by mass media telling you, oh, the inflation's supposed to be this, but it's actually only this, so that's good. No, it's supposed to be below 2%. It's supposed to be below 2%. That's been the mandate goal for a while. 3% consistently is destroying this economy, especially coming off of an economy that had 9%, 7%, 5% inflation. That is not good. That is not good. And so here we have the actual inflation rate we can see from 2021 up through 2022. That's when it started getting insane. This was the Biden administration with Jerome Powell as the chair, and then started to wean down. But as we move through 2025, we can see it's starting to go back up again. That's not good. Let's move on to that next graph or next tab for us, because I believe we have the actual Bureau of Labor and Statistics data. So when you hear 3%, I want to be clear about what you're getting there. You're getting the average, weighted average of all of the goods and services together. But when you get that report, when you see that report come out, you can go to the BLS website and then you can click through all of the items and see where the actual inflation is. Do we have screen? We're good? So let's actually click through onto the next page. I don't even want us to, or actually click food real quick I want to explain how this works. So click food, and then you'll see we have food at home and food away from home. Let's do food at home. These are your groceries. We have cereals. We have meats. We got dairy. We got non-alcoholic beverages. So let's just focus on meat and non-alcoholic beverages. Over 5.5%. Over 5 on both. On meat and non-beer related items, not wine, not liquor. Are you kidding me? The items that matter the most to people are the ones in the report that are going up the most. So let's actually go to the next tab. I want to show you this in graph form. So this is the table actually. So the table, I'm going to take off the glasses to read this one. The table here shows every single item, good and service, that has gone up or down since last year. One thing you'll notice on this graph is almost nothing went down. But I want to point you in the direction of what went up the most. We're not talking about items that you don't care about going up. We're not talking about airfare and hotel and pet insurance and all these little weird line items going up. We're talking about core items. Meat and poultry up 5.2%. Let's keep scrolling down. Full service meals and snacks. This is going out to eat, 4.2%. Fuel oil up 4.1%. Energy services, this is your electric bill, 5.1%. Your natural gas heating bills up 11.7%. If we go down into all items less food and energy, we get to used cars. Don't buy a new car. That's stupid financially. Go buy a used one. Oh, by the way, it's up 5.1%. Tobacco and smoking products. Sorry if you're addicted. 6.9% is your new rate. And if we go into shelter, 3.6% increase over last year. That is the home you're looking at on Zillow. Rent, 3.4%. And if we scoot down one more, I think there's one more, or is that the bottom of our graph? That's the bottom of our graph. So that just shows how it's weighted. Yes, apparel went down 0.1% and new vehicles only went up just under 1%. Yes, medical care commodities went down a bit, but still up 0.7%. But the core line items of your and I's lives are being affected the most, as I karate chop my microphone, are being affected at the highest rates. But when you get the headline number, you're only getting the average. And that average has a bunch of items in there that maybe you don't even care about. And the CPI is the Consumer Price Index. It's how we measure inflation, with a culmination of about 30 to 40,000 goods and services in a basket that they're monitoring. Bureau of Labor and Statistics is who's monitoring it. And they put it out monthly to show us whether or not prices are more or less expensive than they were last year. This number has been inflating since 2020 ad nauseum. So let's move back to our Canva graphic, because as we just stated, now this is where it gets funky. Okay, I want you to put your hats on. I want you to buckle them on tight, lock in with me, because this is where it gets funky. Let's go over to jobs real quick. We just said, if we want the job market to get better, what do we have to do? We have to lower rates. But if we look at inflation, what do we have to do to get inflation to go away? We have to raise rates. In order for the job market to get better, we have to lower rates. In order for inflation to get better, we have to raise rates. This is exactly at the beginning of this video where Jerome Powell said, we do not want to face stagflation. That is our goal. We're not going to have to worry about stagflation because we're just not going to get into stagflation. We're entering stagflation, which is a stagnant wage economy. The wages and the growth of our economy is stagnant, and the cost of goods and services and the cost of living continue to increase. It's called stagflation. It happened in the late 70s. It was atrocious. The only thing that solved it was Reagan and insanely high Fed reserve rates. So what will our Federal Reserve do today as they are faced with a decision as to whether or not to cut, raise, or keep rates the same? If they lower rates, they will be assisting the job market. If they raise rates, they will be hurting the job market. Simultaneously, if they lower rates, they'd be increasing inflation, and if they raise them, they'd be curtailing inflation. So what do they do? First, let's look into the rate basics. The Fed rate is an overnight bank exchange rate. It is not mortgage rates. Be clear. It is not mortgage rates. The Fed rate does not determine the mortgage rate, credit card rate, rate for you to finance a new toy. I don't know. What are you financing? A burrito? Like all the financing rates. If you want to finance that pizza from DoorDash, it's going to be higher because of bonds, but we'll get into that. Now, the rate basics. This is the overnight bank exchange rate that they're altering, that they're moving around. If the rate goes down, that's typically a sign that the market is a frown. If rates are going higher, it's typically a sign that the market's on fire. On fire meaning prices are increasing. Not always things are great. Can be because things are great, but usually because they're overcooking. Things are getting too hot too quickly. Prices are increasing too quickly. GDP's moving. Stock market's moving all too quickly. Which is why there's a lot of argument for maybe we should be raising rates. I'm of that argument, by the way. But last month and seemingly this month as well, we're going to lower rates. Now, let me ask you something. What do you think happens when we do the opposite of what the market says? If we put the rates higher while the market's a frown, or we bring the rates down while the market's on fire, what do you think happens? Let's look at it real quick. Let's zoom out real fast. I think the graph is right below it. So let's go to mortgage rates real fast. I want us to be clear what determines mortgage rates, because many people in this video right now, they want to buy a house. If you want to buy a house, you want lower mortgage rates. This is a graph. It only goes up till 2021 because it cuts off when rates go insane. It doesn't really matter. What I really want you to see is this is the 10-year Treasury bond matched up against the 30-year average mortgage rate. What you'll see here is the 30-year average mortgage rate moves in tandem with the 10-year Treasury yield. Now, what's the 10-year Treasury yield? This is debt. We sell our debt to foreign and domestic investors. When we sell that debt, we are creating what's called a yield. The yield is the return that the investor gets on holding the debt. So they get the debt. They're holding America's debt in the form of what's called a bond, and they're going to hold that bond and get in return a yield. That yield is what's going to inevitably determine your mortgage rate. That's the 10-year Treasury yield we see here on the screen. Now, when the 10-year Treasury yield, which by the way, it's called a 10-year because you got to hold it for 10 years. You got to hold it for 10 years. Now, I don't even want to get into what's going on with the bond markets right now. That's not what this video is about. But we got a lot of infiltration from the Caymans. They're now the #1 bondholder on the planet. If you didn't know that, Japan doesn't hold the most of our debt anymore. They've been selling off. China, they've been selling off. The Great Britons of the world, they don't have the most debt of ours in the world anymore. It's the Cayman Islands. We're not even going to get into all that. Look that up. Look up Federal Reserve Cayman Islands. You'll find it. We are in a weird scenario with our bond market where the bond market is seeing a different economy than what our Federal Reserve is doing. Our bond market is seemingly saying, hey, we need to keep rates higher longer. But the Federal Reserve is saying, nope, it's cut time. So let's move over. I think it's to the left-hand side of the graphic where we have, the money printing. Yep. Oh, no, the cuts. You're right. The cuts. Beautiful cuts. Too late, pals. Too late again. On what exactly, though? When he's called too late, Powell, he's being called too late for too late to the game for cuts. Fed rate cuts. Now, many people believe that if we cut the Fed rate, immediately the bonds will drop too. And if the bond yield drops, rates for you drop. Car loans, credit card loans, mortgage rates. That's important to you, right? Of course. But the Fed doesn't determine it. The bond market does. And here's a little bit of proof for you. So I want to start us on the top peak of that red line on the left-hand side. That is spring of 2024. This is when rates had gone up pretty significantly and people were paying obnoxious mortgage rates. Now, if we look at that blue line, it starts to drop right after that. Right after that, it goes down. Why did it start going down? Because the Fed started to begin to basically hint that they were going to start cutting rates. So this is what's called cooking in the rate. The market is foreseeing the rate cut, and they go ahead and cook it in. Now, what happens from there? They cook in a rate, then the Fed rate cut actually happens. That first yellow line. If you're in the chat right now watching live, can you tell me right now what happened to the Treasury bond after the first cut? Because we're being told that if the Fed rate gets cut, the mortgage rates go down. But what happened to the 10-year Treasury rate the first time we cut? Everybody's getting it right. It went up. The moment we made the first cut, right there in the yellow, the rates went up. Now, let's go to the next cut. This next cut happened in October. The first one happened in September. This is last year. The next cut happened in October. What's interesting about the second cut is we even see a little bit of cooking in. Right before the cut, it drops ever so slightly, cut happens, and then what happens? It goes up. Then we skip November, we go into December. Starts to cook in a little bit, and then rates go up. Zooming out ever so slightly, we can see that the mortgage rates and the 10-year Treasury rate were higher at the end of the cuts than they were at the start. Look at the red line. They were higher before the cuts even started getting rumored. Then we have 100 basis points worth of cuts, and it's higher than it was before. Explain that to me. You can't unless you also look at the bond market. Our bond market is weak right now. Our 10-year, 20, and 30-year bond auctions are weak, and this is investors buying our debt. Why won't investors buy our debt? Because our dollar's weak, our debt is growing, and our deficit is growing. They don't trust our economy, and we're starting to see it again. Let's go to now 2025 on that graph. We have another cut that just happened last month. That is the first yellow line. Now, what do we see from the red line to then? We see pricing in the cut. From mid-July to September, the 10-year Treasury yield began to drop. Then the cut happened. And what happened? The 30-year mortgage rate, the 20, 30, and 10-year bonds went up. We're going to more than likely see the same thing happen again today, guys. I don't know, because obviously you can see where the graph cuts off. I don't even know if we're getting a cut today. My guess, we're going to get a quarter basis point cut, and that is going to lead to the bond market reacting with increased costs for 10, 20, and 30-year bonds, which means today would probably be the lowest mortgage rate you could get for the next foreseeable month or so. I'm not here to try to give you a magic crystal ball to look into. I'm here to read the tea leaves with you. The tea leaves say when we make a cut before the investors outside and domestic are ready for a cut, the rates go up. So what do you think is going to happen today? Is the dollar any stronger than it was last week or last year? Or I'm sorry, last month or last year? No. Is the housing market any stronger than it was last month or last year? No. Is our government, our politics, is it in a better status right now than it was last month or last year? No, the government's freaking shut down. We're going to more than likely see bond rates go up. Now, this leads to the mystery mouse tool of the Federal Reserve. The mystery mouse tool of the Federal Reserve is this cute little tool that allows them to, through some magic computer tricks, to create money out of thin air. Now, you may have heard the Federal Reserve prints money. I want to define exactly what it is. The Federal Reserve actually doesn't print money. What they do is they do this thing called quantitative easing. If you're unaware, quantitative easing was invented in 2008. We had never done this before until 2008, where they create new money on a computer. They then hit up a bank that holds a lot of bonds, a lot of residential mortgage-backed securities, and they say, hey, we're going to buy these from you. We're going to hold them now. These are ours. And they hold them off market. They make sure those bonds, hear this is very important. They hold the bonds off market. Now let's caveat real quick and do a supply-demand definition. When demand is high and supply is low, what happens to the value of the product? When demand is high and supply is low, what happens to the value of the product? It goes up. Let's flip that. When supply is high and the demand for a product is low, what happens to the value of a product? It goes down. It's the opposite. Now, in the bond market, we're seeing weak bond auctions, which means we have lower demand for the bond, for our debt. So what we're seeing is a drop in demand while we need more debt, more supply. So what's going to happen as we need more debt, more supply, but there's less demand for the actual debt? The value goes down. And when the value of a bond goes down, the yield goes up because you have to incentivize the investor to buy it. If the market looks great, they'll be like, cool, 2% yield, awesome. Everything looks fantastic. I can't wait to hold this for 10 years. But if it looks inflationary, if it looks shaky, then all of a sudden you want a higher yield. I hope all of this is making sense. Put a 1 in the chat if this is making sense. Put a 2 if you're completely lost. So bonds are the backbone of rates. The Federal Reserve and the Fed rate decisions do alter it, do create new sentiment, do create trillions of dollars worth of movement in the economy. But they do not immediately determine mortgage, car, credit card rates. Credit ice cream. We're making you finance your ice cream now. That's the next move on DoorDash. So let's move into quantitative easing because I want to show you a graph real fast. This again was invented in 2008. The Federal Reserve created quantitative easing in 2008. We can zoom in on QE1. Guys, what was going on in 2008? Do we remember? For those that weren't born yet, I know there'll be a few out there. That was when we had a housing market crash. We had a bank failure in March of 2008, followed by another bank failure in September of 2008 that led to a credit crunch that led to no mortgages being given on subprime loans that were holding people in their homes with adjustable rates that they needed to sell. When no one was there to buy because they couldn't get a mortgage, prices went down, market collapsed. Now, you may be asking yourself, Zach, why is it that post-2008 rates began to go down? You just told me that when bond investors are fearing the market, that rates go up. Now, this is a weird one, guys. Rates did indeed go down post 2009, 2010, and really stayed marginally low all the way until 2019. But why? The market had just tumbled. It was bad. Banks were failing. We thought there might be more. We didn't really know the full scale of the crash yet. That's when the Federal Reserve called up BlackRock. Happy 13th, by the way. That's when the Federal Reserve hit up BlackRock. And they hit up BlackRock to have a consult meeting with them to decide what they should do. And what they told them to do was do this thing called quantitative easing. They also bought like $140 billion worth of toxic mortgage assets, but that's to the side. They suggested this thing called quantitative easing, which I have marked in yellow. This is when the Federal Reserve creates new money, goes to a bank, goes to an institution that holds bonds or residential mortgage-backed securities, and buys them off of them. Now, why did they do this? Why did this get enacted for the first time in 2008? Well, because rates weren't going down. People couldn't afford anything. Companies were struggling heavy. Unemployment was spiking higher. But what if I told you 2008 was supposed to be worse? The crash that followed the bank crisis of 2008 was supposed to be worse and last longer. So instead, We kicked the crash can down the road. Said, we're going to handle this another time. We don't need this right now. What they did is they printed money to buy bonds. Now let's go back to the supply demand. If there is high supply and low demand, the value goes down. And at the moment, the demand for bonds was low, but debt was needed. The only way we could get bonds down is if we got the bond market investors excited about bonds again, specifically long-term bonds. So what did we do? Let me throw you through a scenario real quick. I want to imagine you sell drugs. You're a drug dealer. If you were selling drugs and you were selling this white powdery substance that we will not name for the sake of YouTube to your constituents, this was your job, not just a hobby. This is your career. You've been doing it for years. You have supply, you have demand. You have the people that are making it, you have the people that want it. Now, if you are selling these druggos and all of a sudden people don't want them anymore, what happens? If you had a great chain of supply and demand going and you were growing and growing and growing and growing, you got truckloads of it going out at this point. You ain't slinging on the street anymore. You're crazy. What's going to happen when your demand dries up? There's something new on the streets. There's something new going on. Your old stuff. Ugh. Ooh, I like that comment. You could go out of business, possibly, but you could just lower the amount of supply. You could lower the amount of supply and that would work. Or you could buy your own supply. You could get high on thine own supply. You don't have to actually have it. You just got to buy it. And this creates false demand. If we create false demand, you then create the price to be accepted. If people see that people are buying it, like, oh, this is the price. So what did the government do? Well, let's change out some words real quick. Let's change out the word drugs for debt. And then let's look at the supply. We saw in 2008 through 2010 that nobody wanted our supply. So we bought it ourselves. Instead of lowering the amount of debt drugs we're manufacturing, we decided to keep that amount of manufacturing up while simultaneously buying our supply. We created money out of thin air to go buy bonds, long-term bonds. And when we bought those long-term bonds, it lowered the yield. It lowered the yield because it increased the value of the bond. Why? Because we lowered the supply available. We created false demand. And then we did it again. And then we did it again. And then we did it again. Let's bring back up that graph real quick. QE1 was by far one of the wildest scenarios we've seen in the Federal Reserve. Nobody saw this coming. This was brand new. It had to be explained to people, and people still didn't understand it. People don't understand quantitative easing till this day. What happened after that? Well, they ended the cycle, and then in mid-2010, decided to do QE2. Now, QE2 was a little different. They said, we don't need to buy long-term bonds. Let's buy short-term bonds. Let's buy T-bills. And you could see that wasn't really super effective. So QE3 came along. QE3 was what brought the market all the way back. It brought it all the way back. Once QE3 hit, rates dropped and the market opened back up. People were having sex and buying houses again. '08 was over. QE3 was the moment. We bought tons of long-term bonds. It ended in mid-2014, and then they held that amount that they held up until 2018. But what happened in 2018? So the blue line, just to be clear, can we scroll up because I think it actually reads it out too. The blue line, the definition of it should be at the top of the box. Right there, yep. Assets, securities held outright, mortgage-backed securities, Wednesday level. So this is only the mortgage-backed securities. This isn't even counting the bonds. But look how many they own. Every time this blue line goes up, they're buying more assets off the market, making our economy less of a free market. They're holding supply off market to make it seem better than it is. QE4, that was 2020, COVID. They lowered the rate and they printed money. They lowered the rate and they printed money. This is what they do. They lower the bank exchange rate to give freedom to banks to exchange money more freely, become less likely of becoming solvent or even failing, while simultaneously adding money to the economy to buy up supply to suppress the bond market to lower rates for you and I. This opens up credit. We are a debt-based economy. This is exactly what's going to happen again. Because as we can see from 2018 until QE4, and then after the end of QE4, they went into this phase of what's called quantitative tightening. What is that? New term. New term unlocked. It is when they sell off those assets they bought. All those bonds, residential mortgage-backed securities they hold, they started selling them off until QE4 hit. And they're like, wait, stop selling, buy more. And you can see they did that all the way up until 2022. But then what happened after that? About 6-8 months go by and they go back into quantitative tightening. That's where we are at right now. And I'm here to tell you with all of my magic crystal ball that this will end. It may not end today, but it's done this year. There is zero way that we're going to be able to keep quantitative tightening. The bond markets, all the summer bond auctions, awful. Anything over 10 years, bad, had a long tail. We are in a market where the bonds speak more accurately about the economy than our own administration does. Our own administration will say that inflation is dead. It's been slayed in battle. It is gone. No, it's not. It's still here. It's still affecting the everyday person's grocery cart, health insurance bill, and home cost. They'll be the first people to tell you that the job market is on fire. It is strong. It is not. We're getting layoffs every day that are coming from everything from tech companies to farms. Nobody is succeeding job-wise in this market. Why? People need too much money to survive, so that requires a higher wage cost. And then we have suppression of their own revenue. They're paying higher taxes. They're paying higher everything to get their corporation running. Everything you're paying, they're also paying. They have to pay to keep their lights on. They have to pay to keep things in store. They have to pay to keep payroll up. And that same payroll is demanding more money because their costs are going up. So they're struggling. They're tight. They're going to print money. They're going to print money. Shout out Sean Wright liking the live. They're going to print money. And when they do, it will lower the bond rates because we'll suppress the bonds by buying up our own supply. Yep. This is the money printing people talk about. There's only two different types. Bank bailout, that's legislative. That comes from Congress. That comes from a law that gets passed that says we need to bail out this entity for this reason to this amount. Then we have quantitative easing. This is from the Federal Reserve, our central bank, which, by the way, they are not a government entity. They are not federal, and they do not hold reserves. They are the Federal Reserve. This quantitative easing, made up in 2008, is going to happen for the fifth time in 2026. Clip it. Clip it. What's the hand motion for clip it? Do it. It's going to happen. And when this happens, we'll see bonds go down, they'll be suppressed, and we'll see our economy inflate. And if it doesn't happen in Q1 of 2026, let me just tell you when it will more than likely happen. Sean, can you look up Rick Ryder, Federal Reserve Chair? In May of 2026, and before you bring that up, I want to make sure we've covered everything in our Canva graphic. In May of 2026, Jerome Powell is going to be all done. Trump wanted to fire him. Other people wanted to fire him. It's not going to happen. You can't fire him. That's basically like him firing somebody on the board of Walmart. It's technically a private entity. May 2026 comes, we're going to get a new Fed chair that is appointed by Donald J. Trump. It is not conjecture or political speak to say he is going to get a puppet in that position. Why? Because he has literally said he is going to get a low-rate guy in that position. Low-rate guy. Scott Bessent, Treasury Secretary appointed by Donald Trump, also said he wants to have a low-rate guy. They both think Jerome's held rates way too high, way too long, and he will be in May 2026. But can I tell you who the front runner is right now for that position? It's going to hurt when I say it because we just celebrate their Big 13. Can we bring up that screen? You got it pulled up real quick? You find that? Rick Ryder? There he is. Say hi to Rick, everybody. Say hi to Rick. Rick Ryder right now is the front runner for the Fed Reserve Chair position. Let's read his job. Rick Ryder, managing director, is BlackRock's chief investment officer of global fixed income, head of the fundamental fixed income business, head of global allocation investment team, a member of BlackRock's global operating committee, and chairman of the firm-wide BlackRock Investment Council. Ha ha! So when these guys, you see it? The link's in my bio if you want one. These are really good. So if you see these guys getting into positions of authority, you should be concerned. But one other concern may be that somebody whose current job is to work for the number one asset managed fund on the planet to further the bank accounts of billionaires via global investment, that maybe that person shouldn't be considered for having the reins of our economy. I don't know. I'm just spitballing here, but the person whose current job is global investment for the world's largest investment firm on the planet is now going to be in charge of the reins of our economy while they're simultaneously investing in Australia, and they're opening real estate investment trusts in India, and they're buying power grids across our country. They're buying power grids in Europe and England. That's the same thing, I know. And they're going all over the planet. They're invested in like 14 blacklist companies in China. The companies that he has said, that our administration said, you can't invest in these because they're using AI to like monitor biologics and track people, and they're using security cam footage and marking where everyone is at all times, and they're using AI drones to create war. They're invested in those companies. The very companies that are going to create AI-backed super cities, they're invested in. The very chief investment officer of that company is about to be the Federal Reserve Chair. And by the way, Larry Fink is currently sitting as the kind of in a term. He's only there for a moment. He's supposed to be voted in with somebody else. But Larry Fink right now is sitting in the chair of the World Economic Forum. So let's walk through real quick what would benefit BlackRock. BlackRock is the number one asset manager on the planet. Lock in with me. Listen to this. BlackRock is the number one asset manager on the planet. $13.5 trillion worth of assets under management. That is a 14-digit number. Try to wrap your head around it. It's 14 million millions. That same person, that same company benefits from assets increasing in value. What increases asset value? Asset inflation. What causes asset inflation? Monetary base expansion. What causes monetary base expansion? When we add money to the economy. What adds money to the economy? Quantitative easing. In 2008, BlackRock suggested quantitative easing to the tune of trillions. Why? Because it temporarily kicked the can down the road for their number one section of their investment portfolio, seeing as they have a advisory share of over 90% of our stock market. It keeps America going for now, but simultaneously inflates assets. It inflates assets. Guess what happened in 2020? Hey, quick check in the chat if you're listening to this live. We do this live 11 a.m. before the actual release later that evening. And by the way, if you missed part of this, this is going to be on Spotify and YouTube. Subscribe on the Spotify. And you listen to this later, send it to someone whose eyes are shut. You want to open up. Can I tell you what happened in 2020? I want you to guess in the chat. In 2020, when the Federal Reserve needed a helping hand, who do you think they called? Who are you going to call? BlackRock. That's who they called. They called Larry Fink and BlackRock in to suggest that we lower rates to zero and we quantitative ease. And now the very company who advised the last two sections of that is now potentially going to be in charge of the entity that gets to do it. And you're trying to tell me it's not going to happen? I think you're crazy. I think the bond market has responded. The bonds are not going to go down naturally at this moment. The bonds are going to keep going up until we buy our own supply. We got to get high on our own supply. That's what's going to happen. Sean, do we have anything else on the Canva graphic that we need to hit? Did I miss anything? Let's rock through it real quick. Let's go a quick little summarization for those just joining us. The Federal Reserve has two choices under their two mandates. They can either raise or lower rates. If they were to lower rates, that would increase the job market strength while simultaneously creating inflation. If they were to raise rates, that would hurt the job market by lowering credit, but simultaneously be a headwind against inflation. If they hold the rate steady, that will simply just keep us where we're at, and we see inflation moving up and the job market getting worse. So keeping it the same more than likely wouldn't do much. Bond market would stay stable more than likely, but honestly, we're going to see a rate cut today. We're going to be live again here at 2:30 when they actually do their meeting. You can hear it first. They are going to cut the rates by at least a quarter basis point. That is just what's going to happen. They'll more than likely hint at quantitative tightening getting dropped in lieu for quantitative easing. He will not say the word quantitative easing, by the way. I promise you, he will not say the word quantitative easing. He more than likely will suggest quantitative tightening is coming to its end. I bet you he gets asked a question about it. I bet you he doesn't bring it up himself. I bet he gets asked and then it gets brought up. But we're walking in the stagflation, folks. And the Federal Reserve and Jerome Powell, I don't envy his position. I really don't, because I don't think there's a right choice to be made today. I think that through the administration, through tariffs, through international trade, through our own agriculture markets. I mean, you could look at any market you want, from the job market to the recently unemployed application rate to actually find a job, to the homeless number, to looking at even the degreed under 30-year-old male having a similar unemployment rate to those without a degree. Everything all around doesn't look great. So what do? Do you lower the rate and try to improve the job market while simultaneously allowing everything to get more expensive? Or do the opposite? The answer will more than likely long-term be money printing. But today will more than likely just be a little rate cut. But we will absolutely keep our eyes on the very happy birthday, BlackRock, now celebrating their $13 billion under asset. Man, I'm sorry, 13 trillion. Billion. What are they, poor? 13.5 trillion that they have under management is now one of the front runners to our central bank. They're running right toward it. It's right in their sights. Y'all, that's it for today. We have a great meeting that's going to happen today. It's going to be a wonderful meeting, beautiful meeting. We'll be live here at 2:30. There isn't a good decision to be made, but my prediction is the decision will be a quarter base cut. They will hint at QT going away. Questions will ask about QE and the bond market. And stagflation will get asked about. That's my 3 bingo cards. QT, QE, and the job market, or the stagflation will get asked about. We'll be here. We'll keep reporting it. And we'll keep covering the economy and everything that matters to you in the young Gen Z millennial markets here on this show. We do it live on TikTok at 11 a.m., recorded on YouTube and Spotify. And this has been show number 34 of the ZFS podcast. Have a great one. Stick around if you're in the live.